Welcome back, everyone, to the Risk Intel podcast, powered by SRA Watchtower, where we share risk intelligence with experts from across the banking industry. I'm your host, Ed Vincent, CEO at SRA Watchtower. Hello, welcome to season 3 of the Risk Intel podcast. We're excited to kick off 2025 with a special guest here today, it is Joe's first time on the podcast. So please join me in welcoming Joe Fenech to the Risk Intel podcast with us today. Joe, thanks for being with us.
Ed, thanks very much for having me. Good to be here.
Joe, we're gonna talk a little bit about the outlook for 2025 in a second, and clearly it's a whole new world out there, right? With a new market, a new administration, and kind of banks in a very interesting position entering the year. Before we do that, though, let's set the backdrop here a little bit, perhaps by sharing some of your background as to kind of what you've done in the space, right? You've been in and around the banking arena for 25 plus years, sell side, buy side, and so forth. So, could you give folks a little bit of your background and why this is an interesting topic for you to dig into today?
Yeah, no, happy to do it. Yeah, like you said, 25 years in the space this year, all in banks. Investment banking early on, quickly figured out that wasn't for me. I got into research, which is where I spent the bulk of my career. Firms like Sandler O'Neill, now Piper Sandler, then started a research department at Hovde Group. And then 4 years ago, 4 years ago this month, decided to take the plunge into asset management and the buy side. So started a fund called GenOpp Capital Management, GenOpp Financial Fund, focused on banks. So basically, I look at it as having done the same thing all the way through. It's just kind of with different titles along the way. But banks for 25 plus years here.
I love it, and really, so it's right. It's the same center, but perhaps looking at it just from slightly different angles, right? Which is gives you a great vantage point as we think about now 2025. So let's get after that discussion then. From a big picture, Joe, right? What's the M&A outlook shaping up for in the banking industry heading into 2025, and how does that compare to perhaps what we're coming off of in 2024, but also cycles behind that, right? You've lived through a number of these different cycles. So how do you compare and contrast what you think we're looking at now versus some of those prior experiences?
Sure. Always an exciting topic. People like talking about M&A in any sector, right? But I think it's going to be, for banks, the most active M&A market we've seen in years. And there's kind of a few specific reasons that are all sort of, Ed, converging at the same time, I think. The first is that for my entire 25-year career in the industry, the banking industry has been in sort of this natural state of consolidation, right? So it started
Yeah.
before my time. The interstate banking laws come down in the 80s, then Glass-Steagall in the 90s when I was getting started, eliminated the barriers between capital markets and the traditional bread and butter banking business. So when I started in the late 90s, there were 11,000 banks. We've seen on average about 200 to 250 M&A deals per year since then. There are now just over 4,000 banks, and we think that natural state of consolidation will eventually result in that number getting cut by more than half again to less than 2,000 banks. And I think that'll happen by the early 2030s. But the reason why it's going to be so robust over the next few years in particular is because for the last 5 years, really since COVID, there's been very little M&A activity, right? Stock prices were down. There was a lot of volatility. I don't have to rehash all of that. But the bottom line is that there's now a backlog that's been building from what otherwise would have been that continued natural state of consolidation that we had seen for the prior 20 years, right? So that's the first reason. It's just a simple backlog. The second reason, I think, is the aging and the management succession challenges the industry is facing now, right? And there are specific reasons for that as well. The 2008 recession destroyed the reputation of the industry. And who the heck wanted to kind of come into the banking business as a younger person around that time, right? So we kind of lost the whole generation of new people coming into the business. So the average age of a bank CEO today is 61 years old. 1/4 of all bank CEOs are 65 or older. Only 7% of public bank CEOs are under 50. And what you don't have behind that group is that next generation of people in their 30s and 40s ready to take the reins. So, in addition to sort of that natural state of consolidation I talked about earlier, you've also got this management succession challenge. And then lastly, the skies are finally starting to clear in terms of the fundamental outlook for the banking business, and stock prices are beginning to follow that. So, putting that all into the mix together, all of those things that are coming together and coalescing at the same time. And I think the result is going to be an absolute explosion of activity over these next couple of years.
The so three themes there, right? The backlog, right? And as you pointed out there, Joe, right? If there were 200 to 250 of these a year happening, and we've had really a dry spell for 5 years, right? That's a pretty significant portion of pent up both demand and supply, right? On both sides of that. The management succession point is a really interesting one, and so I don't want to foreshadow perhaps one of the answers to a subsequent question here, but it makes me think that, well, if you have a robust succession plan in place, or perhaps that next generation of management ready to take over, that puts you in the catbird seat in an environment like this. And then the sky's beginning to clear, right? I think that there's probably a number of different things that you mean there. So I might ask you to unpack that last bit a little bit about, right, kind of the things that are clearing, right? Whether it's the macro environment, the political environment, the financial environment. Kind of dig into that skies clearing comment a bit, would you?
So I think, there's been this misperception about banks, right? That banks can't handle this higher level of interest rates. And that's why we had a banking crisis last year. The fact is that interest rates are still below really the 75-year average.
Right.
And banks, for most of that period of time when interest rates were this high, think back to pre-08, they traded at much higher valuations than they do today, right? So it's
Yeah.
not the absolute level of rates that's the problem today. It's the how rapidly banks had to adjust from where we came from, which was this period of
Right.
zero rates. So you had these balance sheets that were built for zero rates now have to adjust within 2 years to this, rapid inflation and higher rate environment. That process, Ed, is just about complete. So industry net interest margins bottomed in the third quarter for the entire, there's going to be some stragglers here, but for the most part,
Yeah.
margins bottomed in the third quarter. And now the rate environment, even if we don't get rate cuts here, is now going to be a tailwind to margins as opposed to being a headwind over the past 3 years as rates were going up. So it's really, my comment is really around the skies clearing, is that balance sheet adjustment process is now complete. And now the rate environment is going to be a tailwind rather than a headwind to bank fundamentals.
All right, that's great. Thank you for clarifying that.
Yeah.
That's a really helpful point of view, right? Because that is a real specific item that you can kind of put your finger on and say, look, it's quantitative, it's definitive, right? And it is, right, assuming, right, that there's not some crazy event occurred, right, which is what obviously was the trigger for that massive adjustment, right, 5 years ago, right? Assuming in a somewhat stable environment, then the banks are positioned in the current space.
Well, usually what happens, if you think about it, yield curves steepen. The yield curve steepens. We've had the longest and deepest period of yield curve inversion since the early 80s, right? It was the
Right.
period we're just coming out of. The yield curve's now steepening. When the yield curve steepens, it's usually a bad time for banks because what's happening? The Fed is trying to solve for a major credit dislocation in the economy, right? So this time you have the yield curve steepening, which is good for banks without a major credit problem to solve for. So that to
Right.
me, we've never really seen that before. That's sort of nirvana for the banking business. If you think about it, you get all the benefits of the yield curve steepening without any of the associated costs. So that's another,
Right.
another reason why we're just super positive here right now for the fundamentals of banking itself.
All right. Let's take those concepts then, right? The kind of the fundamental landscape, right? The skies clearing, and and drill down a level now and say, all right, let's put this into the context of M&A, right? Where the way we began the conversation. Um, who are the winners and losers going to be? How is the M&A going to differ in this cycle for a regional bank versus a community bank, and kind of take it from the kind of the conceptual down a level and really apply it, because right? They are, I imagine you have views on things being pretty different based upon whether you're a regional bank versus a community bank.
Yeah, for sure. So I don't think it's a novel idea on my part that we're going to have an M&A wave, Ed. There's a lot of people in that
Right.
camp. But where I
Yep.
do think we have a differentiated take on it is the complexion of this M&A wave is going to look a lot different than it has in the past. So in the olden days, as my kids like to say, you get a wave of consolidation and everyone wants to own the sellers, right? Because presumably the selling bank's trading at a certain level, the acquiring bank would have to pay oftentimes a big premium to get that selling bank to agree to give up control. I think this time the difference is, for the reasons I mentioned earlier, there are a lot more sellers than buyers because of that management succession challenge at the community bank level. Remember, only 7% of public bank CEOs are under 50 years old. Then you also have to be in good standing with your regulators. You got to have management depth and infrastructure and all that stuff. You have to have a stock currency. But then also what's unique to this cycle is, with interest rates up so much, the value of the assets on bank balance sheets are almost across the board less than they appear to be on paper, right? So if a bank has a lot of long-term, low fixed rate loans and securities, that has to be marked to market in an acquisition. So it's a hurdle to getting a big premium to market in an acquisition, if that makes sense. So when you're talking about community banks versus regional banks, there's some big differences there. Community banks have a lot more of these long-term, low fixed rate assets, and the management succession challenge is more acute in a community bank than it tends to be in a regional bank. So, a typical community bank, there's maybe 2 to 3 people at most within management or the lower ranks that have the ability to run the organization as a CEO. Sometimes there's only one person, and that's the current CEO. And as I said, the average age of that person is 61 now. So you have succession challenges in management, you have succession challenges at the board level. So in community bank land, you've got all these banks with these challenges. You got a lot of banks with significant rate marks. Like we said earlier, the assets are worth less than what they appear to be on paper because of rates, and you don't have as many capable acquirers. So to me, it's back to the basics of supply and demand, like you mentioned. You have a lot of supply in the form of companies wanting or needing to sell, but not enough demand in the form of capable acquirers. So when you have that
Right.
imbalance, what does it do? It impacts the price. So I think you're going to
Right.
see a lot of M&A activity among community banks, but at lesser market premiums than maybe people have been accustomed to seeing in the past.
So that's really a really interesting dynamic there of the fact that if there is this large supply, and if folks are perhaps not going to be able to get the premiums that we've seen in past cycles, um, does that then say that maybe some of the buyers are interesting in investments here as well, because that if that's the long-term play, that they can acquire these smaller banks without overpaying, it means that they can really build build a bit of a tailwind in their organization, because they can acquire some of these really desirable assets.
Exactly right. So that's from a portfolio management standpoint for what I do. I think that's an important distinction, right? Is you can't just go out and do like in prior cycles and just buy all the targets and think you're going to
Right.
get big pops. So, we are at the community bank level, and then we can talk about the regional banks, but the community bank level, I'm interested in the good community bank acquirers, right? Because if you think about
Yeah.
it, you're acquiring a bank, that bank probably has a balance sheet that still needs some adjustments you need to make. You have the interest rate marks, that I said earlier. But if those interest rate marks don't get better until year 4 or 5, if you're the acquirer, the further out, the longer it takes to restructure that bank's balance sheet, the less you have to pay that person, that guy, for his bank today, right? So the
Right.
acquirers are going to get really good deals that don't look so great in year 1 and 2, and then look awesome in years 3, 4, and 5. So if you think about, this would be an opportunity for investors to really, these acquirers can really add value through M&A in a way that I don't think has been as common to, that we've seen in the past, right? Where most of the value accrues to the target shareholders. So in community
Right.
bank land, own the smart community bank acquirers is our call.
Right, right, and that makes a ton of sense. Now, what do those acquirers need to do to prepare, entering an environment like this, right? Look, we obviously live in the risk management space, right? As a, the kind of as where Watchtower plays in. So we think about it from a risk management perspective. But if you are right, if you're counseling those acquirers, um, are there strategies that they should be thinking about, or characteristics that you look for where you say, all right, this is behavior or ability or capability that they have, that we say, look, this is what is going to allow them to be successful.
Yeah, I think if we see consolidation, but it's driven in part by management succession challenges rather than being driven by strategy, there's some challenges there, right? So what you want to see happen with
Right.
M&A is the target fills a need of the seller, fills a need of the buyer, right? But even then, it's a challenge to make M&A work. Now layer onto that the possibility that the target has to sell and they merge with another bank, but the principal driver of the merger is that the acquiring bank has a management team with just a longer runway to run the bank because of their age or whatever else. So the incentives aren't necessarily aligned to produce the greatest outcome for shareholders. So I think a realistic assessment on the part of the acquirers has to be, do I have the management talent to run this now larger organization, where I might also be taking on new markets that I'm less familiar with? Do I have the systems and infrastructure in place? And then most importantly to your question, do I have the proper guardrails around risk? And do I understand the risks I'm taking on? In some cases, the answer is going to be definitely yes. But because of the nature of this M&A wave, I'm not sure every acquirer is going to be able to answer that question satisfactorily, right? And I think
Right.
people also overlook the importance of the board. Do I have the right people in the right seats around the board table with the expertise and the ability to manage, this now bigger organization? So it's a different checklist, I think, than kind of what we've seen in the past, where deals
Yes.
come together because of strategy and fit. This time it's going to be, hey, I can get this bank at a really good price. And I'm getting that good price because this bank has a management succession challenge or an interest rate mark challenge. So that's a different skill set, I think, than it's been in the past to sort of integrate deals and make them work.
You talked about the distinction between a community bank and a regional bank. Maybe come back to that and
Yeah.
this and this character, right? You talked about the characteristics there of that you'd look for, that you need in order to prosecute one of these transactions successfully. How does that differ when you start thinking about this at the regional bank kind of size and scope and level rather than the communities?
Yeah, so at the regional bank level for M&A this cycle, it's different, and that's where the results of the election, I think, are going to matter, the election we just had. So
Yeah.
our view is we're going to see significant deregulation of the industry, right? Which is going to result in a more streamlined M&A process for everyone, but it's also going to allow for regional bank consolidation really for the first time in a long time. In the first Trump administration, remember, there was a short window that opened up where we started to see large bank M&A. Again, Truist and SunTrust, comes to mind. But then that window
Right.
closed pretty quickly. We think it opens up again. And so what happened last year with the regional bank crisis is that it exposed, I think, a flaw in the regional bank business model, where the regional banks were not immune to fears of a run on the bank, whereas the largest banks were the beneficiaries of that fear, right?
Yeah.
Um, so the combination of regional banks, I think, wanting more scale and the M&A window opening up from a regulatory perspective, that's gonna let regional banks consolidate. To your question, what's going to be different about regional bank M&A versus community bank is the scarcity factor, right? So, for instance, in the Southeast region, there are only 7 banks in the Southeast with over 50 billion in assets. So, in the most demographically attractive region of the country, you've got larger banks wanting scale and better demographics, but there's only 7 targets. So think about, when I said earlier, more sellers than buyers in community
Right.
bank land. It's a supply and demand. It's the same thing for regional banks, but the effect's going to be the opposite. Like if you're a big regional, you have to get one of these properties, or you're going to be shut out for a generation of being able to acquire into that market. So the regional banks, to me, they also have less interest rate marks than the community banks. So the deal math is easier. So the big premiums in this cycle are going to go to the regional banks versus the community banks. So I think you want to own the regional bank sellers and I think you want to own the smart community bank acquirers. To your question on how the capabilities are different, the regional banks just have, because of the regulatory requirements, just have a lot more infrastructure. They have more
Right.
management talent. They have more. So the things I mentioned earlier about fit and all that's like the regional banks just tend to be better from that perspective, I think, from an acquisition standpoint than some of the community banks that don't have that management depth of talent in there are going to prove to be.
I think it's really interesting there, Joe, that that really the first time that you mentioned the regulatory environment and deregulation was when we started talking about the regional banks, right? When you talked about the drivers there in the community banks, it really was low down, if even on that list. But then at the regional level, it clearly becomes a consideration. So are there strategies that institutions should consider to help them close deals quickly and to meet regulatory requirements? I know that that's a little bit of an open-ended question, considering, right, we're going to have a new set of folks sitting in seats in DC soon. But are there any strategies that banks should be thinking about in advance of the new regime coming in?
I think there's some specific things, but I think more broadly, Ed, what you're going to see is just a more streamlined process around M&A. Like regulation goes in cycles just like everything else, right? So if you think about it, we had this wild period of deregulation and light regulation from the late 90s up until 2008. You could argue a lot of that was sort of the driver of what happened in 2008. Then you have a
Right.
whole period of re-regulation after that, and that went overboard. And now we're kind of at that inflection point where I think we're going to go the other way again. So just banks, I don't think really need to do too much from here on. It's just going to get a whole lot easier just by virtue of sort of this changeover and where we are in sort of this longer term cycle of regulation, if that makes
Right.
sense.
Yes.
But there are certainly things, the specifics that you can do to kind of better prepare yourself. I think it really comes down to the management depth and talent. And then the regulatory standing, you're still going to sort of have to have the basic, commercial real estate concentrations, those kind of things have to be in line. And then, your systems and infrastructure have to be in place. And again, I just think there's a small handful of acquirers in each region that sort of check all those boxes at the community bank level. And that's what's going to make this sort of a lot more challenging. But if you have all those things, you're going to get some heck of a lot of good opportunities here. Where I think it's really going to matter too is, in the current administration, you basically had to make sure whoever you're acquiring, you really wanted that bank, right? Because most likely it's going to take a while to close the deal, and then you're going to
Right.
be on the sidelines for a period of time after that. I think what might happen now is you can maybe go after your third priority target or fourth priority target, knowing that you could probably, if you execute that transaction well, circle back if your number one target were to become available 9 months to 12 months from now. So I think you're going to see this mad scramble over the next 18 months. If you really want to do something big, this is your window before the midterm elections and more uncertainty gets introduced in the 2026 midterm cycle. The next 18 months is going to be a mad scramble in terms of big things happening in the space.
It was going to be, I love that description. There's going to be a lot going on. The mad scramble description, I think, is a great way to describe all the stuff which you pointed to, right? The fact that from on a kind of a cyclical basis, we've got all this pent up demand, right? We've had years of quiet and people are ready to go. The fact that you're going to be able to go after perhaps more than one in rapid succession, right? Given the regulatory space. And it feels like, as you said at the beginning, the fundamentals of the institutions are in a position where, right, we have a steepening yield curve, but we don't have, right, this commercial real estate, right, issue we're about to confront, or right, some other credit issue, right, subprime lending, whatever it might be, that is right out in front of us. So it certainly feels like it's going to be a really interesting 12 months to 18 months, as you said, right, until we get people start thinking about the midterms again.
Well, let me add to that one more thing, if I can. I think, 2.0 of this M&A cycle is going to be, sort of the convergence of banking and technology, if you think about it,
Yeah.
because banking products today are not going to be delivered to Gen Z and the generations after that the same way they are today, with the go stand at the teller window to talk to somebody and all that kind of stuff. But I don't think that can happen until, I hate to be ageist about it, right? But until, a 65-year-old CEO is not thinking about how Gen Z is going to consume their banking products 10 years from now, right? Because they're most likely not going to be a part of the industry. So once the industry consolidates, it's going to be really interesting to then see how these worlds of banking and technology converge. And that's where the lighter regulatory hand is going to play a part here too, because you could argue that the tech forward banks have been the most heavily scrutinized from a regulatory standpoint over in this post-COVID era, especially after what happened with Silvergate and Silicon Valley Bank last year.
So I'm going to pose this to you and tell me if this kind of lands based on that comment, right? There were these embedded finance, BaaS banks, whatever terminology we want to use to describe these institutions that were really heavily tech forward, right? They were the pioneers. They took the arrows in their back, right, from the regulators. Um, and it feels like the next wave of this could be not necessarily the emergence of another set of embedded finance banks per se, but instead the acquisition of fintechs by regulated institutions is their way to essentially jumpstart leaning into technology. So there's been this partnership approach. There's been, all right, we're gonna have a charter, but we're gonna have 50 partners. Is the next chapter of this that these regulated financial institutions now go out there and say, I'm going to acquire three, four, five, whatever the number is, right, of these fintechs as a way to accelerate my movement into the technology space.
I think you're definitely going to see that. I think you're also going to see, in my opinion, is all these big brands are going to be in the banking business in some form or fashion, right? So,
Right, right,
Walmart, for instance, is in the banking business. What people don't know is that they operate on the rails of Coastal Community Bank up in Seattle, which is a big holding of our fund. The ticker is CCB. Um, and basically everything Walmart does in the banking business runs on the rails and the regulatory infrastructure of Coastal Community Bank. So,
right.
like a Starbucks, which has one of the most, if you think about it, one of the most valuable deposit bases in the world. Everyone goes and swipes their Starbucks
That's
card. What happens to those? So all these brands are going to be in the banking business in some form or fashion. It's just a question of how. I don't think they'll ever, like, you won't ever see Walmart Bank, right? The regulators, I don't
right,
think, will allow that. But how these partnerships evolve, I'll call it banking as a service 2.0, right? You're right.
right,
The early people took their slings and arrows here, but that's where this is kind of heading, if you think about it, right? You have to have some sort of regulated entity in partnership with a brand that sort of wants to be in the banking business, but has to do it in sort of a tangential way, right? But again,
yes,
is that all going to have to get figured out when you have a quarter of the nation's banks with leadership that's 65 years old or older, and with boards of directors that are older than the management teams, right? It's all
right, right,
retired people on the boards. So you have to
right.
have this generational turnover first. But on the heels of that, closely thereafter, is going to be sort of answering this question of how those worlds of banking and technology come together.
I love it. Thank you. That I think that's a great way for us to bring this conversation to a close here today, right? We've got to look at what is on the horizon, right? What's right in front of us that right, we need to this generational turnover needs to occur, right? That's a huge catalyst for the M&A environment in these next 18 months. And then that lays the groundwork for perhaps this next wave of technology and banking coming together. So it'll be interesting to see how quickly we move through, I'll say, phase one to get to phase two. But this is going to be, as you said, a mad scramble over the next 18 months. And Joe, if you're up for it, we'd love to have you back on to check in as we get a little deeper into 2025, because it feels like things are going to move pretty quickly here.
Sure, happy to do it at any time. Thanks for having me.
Great. Joe Fenech, founder and chief information officer at GenOpp Capital Management. Joe, thanks for being with us today. Greatly appreciate it and look forward to having you back. Thanks again.
Thanks. Take care.